what do you think about the agentic AI systems? Are they can decide things for you or make financial decisions, right?
People use AI agents all the time as a term.
Okay.
We usually say AI system, agentic system, because I think that helps a little bit talking about what is the technology and then what does the technology do. These are systems, so they include multiple elements, and they have software agents that can do different tasks, anything from pulling data to analyzing data or doing different things or reaching out and helping to push money or, it depends on what the agent's built for. And people use them in all sorts of areas, not just financial services. They often also have large language models or other types of generative AI systems that are kind of helping to orchestrate all the elements and do some of the interface with the user. And then they may also include things like machine learning models that are doing really deep, kind of quantitative analytics. So they're this hybrid system with a bunch of parts, which is really exciting because it means that they can do things that just a quantitative machine learning model or just a large language model can't do by itself. Both of those kinds of models, you have to have somebody who kind of turns the model on, right? Asks it to do something and it'll spit out the answer, but it's still kind of dependent on the human to start the process. With agentic systems, you can potentially have a system that is much more dynamic, is able to act in real time and do certain things. Now, obviously, you can have all sorts of levels of human control over it, but there are lots of ways in which that's potentially really exciting. And things like fraud, where we're seeing all sorts of really interesting new things and deep fakes and other types of AI. People are really excited about the potential for agentic systems with appropriate human oversight to be much faster and much more effective in detecting new patterns, figuring out what's going on and reacting appropriately. If you think about something like personal financial assistance, like kind of a pocket advisor in your phone, you could see potentially that agentic systems would not only be able to get consumers' data together, analyze their finances, give them some advice on what might be a good thing to do, but then they could also help execute on the advice and do all the stupid things like watching account balances and transferring funds and, some of the nitty-gritty things that people don't always have time to do for themselves. But the real question is, do we trust the systems? Are they reliable enough that we want them to be, how much do we want them to be doing without the human oversight? That's the question where I think people are still learning and deciding where they want to go. So we are seeing agentic systems, but a lot of them are being built with a great deal of oversight to begin with. And as people get more comfortable and understand, how reliably they're performing, what guardrails are most effective with them, all those kinds of questions, and we'll probably begin to adjust some of those parameters. But it's exciting because it allows a lot more dynamism and a lot more active support for certain activities, like helping consumers just manage their daily, accounts and financial lives than kind of the prior generations of AI could do, because they were a little bit more contained, if that makes sense.
Yeah, I know. This is actually really interesting that having such a big effect, and people are experimenting and seeing where it works much better for them, right?
I would say where we're seeing financial institutions and providers do the most work is mostly internal adoption right now. So things like fraud, where they're building agentic systems to help them react faster. The direct to consumer side is a little slower because it's a little more complicated, and we really want to make sure those things are reliable before, they're kind of out in the wild doing things. But where we are seeing a fair amount of movement is in shopping aspects, which are not purely financial services, but there's elements of that because there's payment involved. We're seeing lots of shopping agents or assistants being launched by all sorts of big e-commerce platform providers and players. A lot of them generally, I think at this point, are still wanting the consumer to click the final yes before they go buy another pair of shoes or the toilet paper or whatever it is. But, as we learn, again, how these work and we build the systems for kind of computers to be talking to computers and interacting in different ways, then those parameters may start to change. So there definitely are places where I think consumers are starting to see some of this. Still a lot to go, and a lot of things that we're figuring out. These are pretty complex systems, in part because there's so many moving pieces, and in part because, each individual component may have its own challenges. So figuring out how to really build them reliably is a good question. And the other thing is that a lot of our kind of modern world, certainly in the e-commerce world, has been kind of built with the assumption that bot activity is a negative, bad actor thing. And now we're talking about having good bots and bad bots. And so that's kind of complicating a lot of discussions and kind of thinking around how do we prove digital identity, and not just now for humans, but also for agents, and kind of how do all these pieces fit together in a way where people are able to do what they want to do and do it with kind of less friction, but we are keeping fraud and scams and bad actors contained. And so there's a lot to do there. And so, again, those are all reasons why the agentic category is, I think, particularly kind of buzzy and interesting, but also pretty complicated to follow. We did a paper on it in September that was just trying to lay out, like, what is this and where is it getting used and what are some of the questions it's raised? Even since that paper's been out, there's just been dozens of more announcements, especially in the shopping space. And it's continuing to move really quickly. So it's very interesting to watch. I think it has a lot of potential, but there are a lot of things to figure out.
Yeah, definitely. This is the most interesting it has been in a decade, I feel, or more than a decade, actually. And happy to be seeing all this. When it comes to credit underwriting, right?
Mm-hmm.
Just wanted to understand how it has evolved over the years. And what does ML-based credit underwriting look like?
Yeah. So, a lot of lenders have used quantitative models of one kind or another, again, for decades. And that wasn't necessarily machine learning. Logistic regression is a kind of, and some people classify that as machine learning, but it's a version that's been around for a really long time. So people have used models for a long time. And a lot of those models are built primarily on credit bureau data. We have 3 nationwide really large credit bureaus in the US and then more specialty bureaus. And that data is mostly made up of how consumers have paid credit in the past. So it can be very predictive, but there are a couple of challenges with it. One of which is if you've never had credit before, you're not in the system yet. And so there's a little catch-22 at the early stage. And some people don't tend to use it or may not tend to use the types of credit that get kind of reported into that system. So there's a number of people, millions of people who are kind of invisible or have at least thin files where they don't have all that much information in the system. The other problem is there can be errors and, just various gaps. And so people have been using kind of this traditional data and these traditional models for a long time. And like I said, they can be very predictive, but they have some pros and cons. And so what we're seeing now is both movement on the analytics to machine learning models and also interest in new data sources that can maybe fill in some of those gaps and give a more complete picture of the consumer or the small business. There's a lot of crossover here with small business, both because lenders often use the business owner's individual credit and the business when it's first starting out. Again, doesn't have a credit record because it's a new business. So you kind of have that same problem. And so a lot of our work has been in this area where we're studying things like the use of bank account data, which gives a sense of inflows and outflows and a broader range of expenses that people may pay month after month that don't always show up in credit reports. So things like rent or utility bills generally don't show up in credit reports, maybe unless something's gone wrong and the consumer's, behind. But it's, again, those are mostly credit records. So people are really interested in use bank account data because it kind of fills in a lot of those gaps in it. And it even for people who are in the traditional system, it shows you some more information that you can't see from the credit report. With machine learning models, they are potentially, they're more complex than what people have done traditionally with kind of a more traditional logistic regression or other traditional approaches. They're more complex, but they can be more nuanced. And they can also, especially with kind of subpopulations who might kind of get masked or overwhelmed in a bigger population, they can kind of tease out more information and so potentially be really helpful in this space. But you do have to really understand kind of how they work. And there's requirements, especially in the lending space, about explaining your decisions as a lender. If you turn somebody down for credit or you charge them higher rates, there are certain requirements about having to explain why you're doing that. And so you have to be able to answer those questions in machine learning. And, more generally for lots of other reasons like risk management, be able to understand what they're doing and are they being fair and all those things. So there's lots of interest in it, but it does bring in some complexity because people need to be ready to manage the models and understand how they work and make sure that they're doing what we want them to do and that they're reliable. So we are seeing lots of activity in this space, and it's really exciting because I think it's one of the places where it does have a lot of potential to really make a difference for, folks who, like I said, are having a hard time getting kind of traditional mainstream credit products and services that can potentially make a big difference to their lives.
That's really good to know. So are we using rent and all utility bills now as part of ML-based credit underwriting?
Some people are, and there's been interest in getting those kind of records into the mainstream credit reporting system for years. People have been trying to do it. It's hard for various reasons, and we've written about this in some past reports if people want to go into the details. But yeah, when people are using cash flow data, in particular that's coming from the bank account side, some of them are looking for what are those recurring expenses that the consumer's paying month after month after month. And you can tend to figure out what they are. I mean, it takes a little bit of work. And that will give you a picture of kind of like the whole spectrum of recurring expenses as opposed to just are they paying their credit card bill and their mortgage if they have one or something. Like I said, it's like a more full spectrum picture. And so that's one of the reasons why people are really interested in the cash flow data. Some people are using cash flow data without using machine learning, but the combination of the two allows you to do, kind of a lot more nuanced kind of analysis of kind of like what's happening to a consumer or small business and how their financial circumstances changing over time.
I think it's really good they're considering all this because I can imagine people who were paying rent were not considered before, right?
Yeah, I think it's really interesting. And there's been research done, and by some folks who talk to individual consumers or people who kind of feel like they aren't really being recognized in the traditional system because
Correct.
They don't happen to have particular types of credit and they're living really, responsible financial lives, but it's just not necessarily getting fully picked up. And that's one of the reasons that I think people do find this pretty interesting and pretty intuitive is that it does give you potentially kind of a more holistic picture of what's happening to the applicant. And so, there's a lot of, really interesting things about it. Like I said, you need to kind of think through it. And the cash flow data, it's a lot of information. It's kind of like the information you see in a bank statement. So it's got, potentially individual transactions and things. And so how do you distill down the recurring expenses and how do you, do the averages so you have a sense of kind of what their income flows are? There's all sorts of processing things to go with it. And that's part of the reason why the machine learning can be helpful is because it can really help with those kinds of math questions to figure out what's really going to give you signals so you understand, is this applicant okay and likely to be able to repay this particular loan?
Well, there's a lot of it is dependent on this data, right? So how do you manage? What if somebody has very less history or no history? Somebody who's just starting college. How do ML models work then?
Well, it depends on the model setup. It will only recognize the data that it's kind of been trained on and that it's feeding into the system. And so when lenders are figuring out these questions, they have to figure out like what data are we going to use. And like I said, people have used credit report data for a long time for lots of things. They also will collect some information on the application form, right? Like they might ask you what's your income, or even in some cases like a mortgage, they'll ask you for tax statements so that you can kind of really verify the income. But those still tend to be kind of high level things, annual tax forms, right? And so cash flow data is one way to do it. People are also trying to get rent and utility data from other sources. And, there's a variety of functions and people are using different kinds of information in different places. But there's a lot of interest in, can we find other sources of financial information that really kind of fill in those gaps? And that's why I think so often we are seeing cash flow data and machine learning kind of occurring at the same time.
Okay, so cash flow is the one which is helping when there's very less credit data, right?
And, some people will use other types of loan information or, there's different things people use in different circumstances, but we are seeing a lot of interest and momentum around the cash flow data because it has all these advantages and does, help to fill in all these kinds of questions. And we're seeing now there are a lot of companies that are developing or kind of helping lenders. So they'll help get the data, move it in, or even process it into specific kind of like metrics that will be useful in the underwriting process. And so that's potentially really helpful for smaller lenders who may not have the technology resources to go build one of these models from scratch and do a huge amount of exploration with the data. But there are lots of kind of third-party intermediaries that are coming into the market. We've been in the space studying it for 6+ years now, and we've seen a pretty big change over that time period. So there's more and more options for people, for lenders who are interested in this, but feel like they're not quite ready to manage it totally on their own.
I also know that all these AI models that we work with, since I work with AI companies also, there's a lot of training involved. You need to train them. And if something changes, and especially in credit underwriting world, people move around, their economic conditions change. How do we handle then? I mean, Before, I think manually you could go change. Now you're dependent on the ML model.
There's really interesting things in that space. And so if we stick with kind of credit underwriting for a while, because I think that's a good example, people would develop models and they would have them in place and use it. And it would, use particular inputs from the credit report and that sort of thing. A lot of times they would have an overlay, which is like, we're going to require a minimum credit score of X, or we're going to require a certain threshold thing. And they would move those overlays up or down, depending on economic circumstances, to try and maintain kind of consistent risk levels. If they know the economy is getting worse, maybe they're going to require a little higher credit score because they want to have more confidence that the consumer is going to be able to handle one. The other option is to retrain your model, like change your underlying model and say like, oh, well, maybe this metric is no longer the most, useful and we want to use this instead. But that's pretty labor intensive and it takes a lot of work. That's another reason that machine learning is really appealing to people, is that you can have faster cycles of training if you want and kind of get in to do that. Now, you still need to make sure the model's reliable at the end of that process, right? And that's pretty intensive, especially on something like lending, because it's really important to everybody that is working well. If you're doing something minor, with your, I'm trying to think of another good example, but, not all models are doing equally risky things. So you might have less validation for something else, but lending tends to be pretty high value. So even today, because of all the things that are important to test and validate, underwriting models don't tend to update dynamically. They're not changing all the time. You kind of go through cycles and you test them and make sure you're ready, and then you deploy them and then you go through that cycle again. But we are seeing models move closer to the point where, and not so much in the underwriting space where we're really doing a lot of math, but when we're talking about large language models that might be used in a chatbot context or something, there are different ways you can structure those so that they're getting new data inputs and kind of refreshing themselves, on a more ongoing basis. There's always a push-pull in financial services. Like I said, it really depends on what you're doing with the model and what the risks are as to how much validation do you need to do, like what's that upfront process before you deploy, and then how quick and efficient is it to then go redo things. And as we're moving towards models that are kind of updating, or at least updating in a minor way, kind of on a more ongoing basis, we also have to really think about like, how do we monitor them once they're out in the world doing whatever they're doing, so that we know if suddenly the model performance is really going down, that probably means something's changed in the data and it's just not working as well. But what are you going to do about it at that point? Troubleshooting, deciding whether you need to kind of re-up your whole model. Those kinds of questions are getting even more important than they have been in the past. People have always monitored their models because economic conditions do change. Like, stuff happens, and if a model's no longer doing what you need it to do and isn't predicting very effectively, then you're clearly going to want to change something. But becoming even more important because AI is often more dynamic, and we have some of these questions, and so that's an ongoing point of tension, and people are continuing to adjust and think through like what works and what makes sense, and how do we balance all these things to make sure, like I said, that the model's not going off the rails and that we're not getting consequences that we didn't anticipate, or or unintended and potentially really negative for somebody who's affected by the particular model.
Yeah, so I guess monitoring these models consistently is really important, right?
Yeah.
So do you have an example where a model made a decision or came up with a decision which probably performed much better than a human underwriter in some case?
I don't know if I can speak at an individual level for an individual applicant, but I think it's helpful to think about it this way. Kind of in the old days, before we were doing a lot of quantitative underwriting or something else, people tended to be making the decisions based on kind of judgmental factors. Like, there was a human underwriter evaluating some things. And, they probably were looking at financial questions like, how much income do you make and how much debt do you have? Like, some of those things are pretty basic and they always look at them. But a human being can only kind of factor in so many of those things. And so you tended to have a lot of kind of rules-based systems that had like thresholds. So if the income isn't above X, we don't go any further in the process. And so that is a little simpler to administer, but it's very rigid. And so the nice thing about moving to kind of more sophisticated quantitative models, whether it's logistic regression or machine learning or something that's further along, is you can do more complicated math, really think about the interactions between more factors and get a more nuanced picture. And you can do it consistently, right? So that the model is being consistent. If you put the inputs in, you get the same answer, and it's kind of treating people more consistently. That's a lot of the reason people felt like this transition was good even before machine learning kind of came on the page, and why they're interested in the more sophisticated models. So that's where it can get helpful, is that it can be really more nuanced and those kinds of things. But it's there are different kinds of errors that can happen here too. One of them is, how good is the data it's trained on? If there are gaps in the data or other errors and flaws in the data, the model may pick those up and not really realize that it's off. And so we have to be, really careful about thinking about those questions. The other thing is understanding how the model is working, why it's doing what it's doing, and if it is going wrong, what you're going to do about it. So the question of transparency and explainability is really important in these models, and more complicated, certainly than kind of the older systems, the rules-based systems. At the same time, in the days where we had lots of human underwriters kind of making judgmental decisions, the human mind is not exactly, it's kind of a black box too, right? And kind of the subjective elements of that are also very hard to understand and kind of pinpoint. And so each system kind of has its pros and cons. There are some really good aspects to this, and ways in which I think machine learning can strengthen and improve on a lot of the things that we've been seeing under older quantitative models that people were frustrated with, the limitations. But you have to manage them the right way and really be thoughtful about how you're doing it, because there are still ways that things can go wrong, and it isn't good for the customer, and it isn't good for the lender or the broader, kind of economic system. So that's where it just is really important to be thoughtful about kind of how you're approaching that.
There are cases where humans have biases against demographics or some other things.
Yeah. And at the same time, humans can also pick up soft information that a really simple rules-based system will never account for. It's a really complicated thing. There are ways in which you can see good human underwriters do a good job, but in terms of consistency and nuance, there are real advantages to these systems as long as you manage kind of some of the other questions that can get harder. And, it's interesting. We're working some with mission-based organizations too, and they often do a lot of work with their individual borrowers, kind of helping people who aren't used to the credit system or don't have much of a track record, kind of get loans or start businesses or all these things. And it's interesting to see how they're thinking about kind of marrying the traditional kind of high-touch things that they do with their borrowers with high-tech things like different types of data and different types of models. And there can be real important pieces to everything. We really think about data and technology as having a huge potential leverage effect in terms of access to credit. But I don't think it absolutely solves everything. There's also a role for humans and human connection and trust building. And, data machines don't give you every single aspect of that. And so, that's important to consider too. But we do see a lot of potential in these kinds of analytics and, being able to process people more quickly, more efficiently, more consistently, all of those kind of potential benefits, which is really important if you want to be able to serve more people and serve people who historically have been kind of expensive to evaluate in the system. So there's really important pieces here that we can, from thoughtful data and analytics, adoption.
Yeah, I guess with data, analytics has become really much more important than before because...
Yeah, having the right analytical tool, having the right data that is high quality and representative and is really going to give you the insights, that you're looking for. It's all really important. And if you don't have those pieces, then things can go definitely wrong. And there's also, with machine learning models and credit underwriting, they often can capture more nuanced, things that kind of patterns that a more simple model might not be able to identify. But you also have to really make sure, are they reliable? Are they more sensitive to data changes because they're picking up all this nuance? And if so, how do you manage for that? And there are different approaches to doing that. But you do really have to think through